If you're over 50 and you've got more than $500,000 sitting in a 401k or IRA, stop scrolling because I need to tell you something that's going to make you uncomfortable. And honestly, good, because comfortable is what got you into this mess. You've spent 20, 30 years stuffing money into that account, doing what you were told, being a good saver. Gold star, right? Wrong. Because while you were patting yourself on the back, the IRS was quietly doing the same thing. Except they weren't celebrating your discipline. They were celebrating their future payday. There's a tax bomb sitting in your retirement account, and nobody, I mean nobody, is talking about it. Here's the deal. Every dollar in your traditional 401k or IRA is pre-tax money. And oh, everyone loved reminding you about that, didn't they? You're getting a tax deduction. You're lowering your taxable income. Like they were doing you some kind of favor. No. What they did was help you kick the biggest tax can of your life down the road. And that can didn't shrink. It grew for decades. Because when you start pulling that money out in retirement, and you will have to pull it out, every single withdrawal gets taxed as ordinary income. Not capital gains, not some special retiree discount, the full rate. And here's the part that should really make you angry. You were told you'd be in a lower bracket by then. For a lot of you, that was a lie. Let me tell you about a guy I'll call Mike, 61, retired from a tech company. 1.2 million combined total between his 401k and IRA. He is a textbook saver, did everything by the book. Mike didn't think about what happens when everything stacks up. Social Security kicks in, a small pension, rental income, and then the IRS forces him to start pulling money out at age 75, whether he needs it or not. They call those required minimum distributions, RMDs. And when those forced withdrawals hit, it's a domino effect. Mike's income jumps. His Social Security gets taxed, up to 85% of it. His Medicare premiums spike from something called IRMAA surcharges. And that surprise doesn't even show up for 2 years. Nobody warned Mike. Nobody warns anybody. And it doesn't stop with you. That tax bomb gets passed down. When you die with a traditional 401k or IRA, your kids inherit it. Sounds nice, right? Except they've got 10 years to drain the entire account. Every dollar they pull out gets taxed at their rate. And if your kids are successful, which you raised them to be, they're in a high bracket too. You worked your whole life building this wealth, and the IRS is going to take a third of it, maybe close to half, from your kids. And here's one nobody thinks about. If one spouse passes first, the survivor goes from married filing jointly to single brackets. Income barely drops, but the tax rate explodes. They call it the widow's tax. Nobody warns you about that either. So why hasn't anyone told you this? Your stockbroker, your financial advisor, the one you've been trusting for 20 years. They know. So why the silence? Because of how they get paid. Most advisors charge an AUM fee, a percentage of everything they manage, 1 to 3.5%. $1 million? That's $10,000 to $35,000 a year, every year, whether they do anything or not. A Roth conversion moves money out of accounts they manage. Their balance drops, their fee drops, their paycheck shrinks. So why would they bring it up? That's exactly why I don't work that way. I'm independent. No big firm, no corporate quotas, nobody telling me what to sell. Roth conversion planning doesn't pay big commissions, which is exactly why the big firms never bring it up. There's nothing in it for them. There's everything in it for you. This one's personal for me. I watched my grandmother lose her retirement savings in 2008. She did everything she was told, saved, trusted her advisor, followed the plan, and when the floor fell out, nobody was there to catch her. That's why I do what I do. And I see the same thing every single week. A couple in their late 50s, early 60s, 700,000, a million, sometimes more, sitting in traditional accounts. They did everything right, and they have no idea what's waiting for them. I had a couple a few months ago. When I ran the numbers, showed them what their tax bill could look like over 20 years, the wife got quiet and said, Why didn't anyone tell us this? That question keeps me up at night. It's exactly why I make these videos. All right, so what do you actually do about this? This is where Roth conversions come in. And I'm going to explain this like a normal human being, not like a textbook, like I'm telling a friend at a barbecue. A Roth conversion means you take money out of your traditional 401k, or IRA, the account where the IRS is waiting at the door, and you move it into a Roth. In a Roth, your money grows tax-free and comes out tax-free. Yes, you pay tax on whatever you move over, but you're paying at today's rates, and today's rates are on sale. That's what my tax bomb assessment is built to figure out: how much, when, and at what rate. Let me show you what I mean. Right now, the top federal tax rate is 37%. They just made it permanent. Sounds great, right? Except permanent in Washington means until the next Congress needs money. And right now, the national debt is closing in on $39 trillion. The government is paying over $1 trillion a year just in interest. Social Security's trust fund projected to run dry by 2032. So when the government needs more money, and they will, where do you think they'll look? Whether you've got 500,000 or 5 million, when taxes go up, everybody pays. That's why I tell my clients, pay the tax while you know the rate. Lock it in. Because 37% might look like a bargain compared to what's coming. And don't just take my word for it. Talk to your CPA. I'm serious. Almost every CPA I work with agrees with this strategy. The tax professionals who do planning, not just preparation, have been saying this for years. Ed Slott, named the best source for IRA advice by the Wall Street Journal, calls your traditional IRA a deal with the devil. He's been pounding the table on Roth conversions for decades. There are $40 trillion sitting in retirement accounts across America right now. Most of it has never been taxed. That's not a national retirement plan. That's a national tax collection plan. The people who understand taxes are saying the same thing I am. Act now. And when I work with someone on this, I'm on the phone with their CPA. Every time. That's how this is supposed to work. Timing is everything with this. The sweet spot is usually between the year you retire and the year RMDs kick in. Your income drops, your bracket drops. That creates space. You fill that space with partial conversions. Not everything at once. You figure out how much room you have in your current bracket and you fill it. Not a dollar more. Next year, you do it again. Year after that, again. You're draining the pool slowly instead of blowing up the dam. It's controlled. It's strategic. And it keeps your Medicare premiums from going through the roof. That window doesn't stay open forever. Most people don't realize it exists until it's half closed. The ones who plan for it save tens of thousands, sometimes hundreds of thousands, in taxes they'll never have to pay. Now, if you're already at the top bracket and you know you're staying there, everything I just said about partial conversions goes out the window. The whole point of filling a bracket is to avoid getting bumped into a higher one. But if you're already at the top, there is no higher bracket. You can convert 100,000 or 5 million and it's all taxed at the same rate. So what happens if you wait? That 401k IRA keeps growing, and every dollar of growth is money the IRS has a claim on. You're literally growing their share for them. Convert now, and all that future growth happens inside a Roth, tax-free, forever. The IRS never sees a dime of it again. Waiting doesn't protect you, it feeds the beast. Let me be blunt for those of you with serious money. You've got $2 million in a traditional 401k or IRA. At the top bracket, that money is really only worth about $1.2 million. The IRS owns the rest. You just can't see it because they haven't sent the bill yet. Here's the play. Convert that $2 million to a Roth and pay the tax from outside money, a brokerage account, savings, whatever. The full $2 million lands in the Roth, tax-free, forever. Don't have enough outside money? You can still convert. You pay the tax from the IRA itself. Less lands in the Roth, maybe 1.2, 1.3 million, but it's still tax-free from that point forward. Either way, you're firing the IRS as your business partner. One way you fire them clean, the other you fire them and give them a severance check on the way out. Now, I want to be straight with you. A Roth conversion is not for everybody. And I'll be the first one to tell you that. If you're in your late 70s or 80s and you're already living off RMDs, the math might not work. You need enough runway for the tax-free growth to make up for the tax bill. If you don't have that runway, it's probably not worth it. And if your IRA is your only source of income and you can't afford a tax hit right now, this isn't the time. But don't mistake not right now for do nothing. I've seen people try to figure this out on their own, convert too much in 1 year, blow their bracket, trigger IRMAA, and cost themselves more than if they'd done nothing at all. This is exactly why I run the numbers before I recommend anything. Anyone who tells you one size fits all is selling you something. So here's what I want you to do. Not think about, do. Click the link below and book a tax bomb assessment. In 15 minutes, I'll show you 3 things: how much of your account the IRS already has a claim on, what your tax bill could look like over 20 years, and whether a conversion could save you 6 figures. Free. No pitch, no obligation. And if after 15 minutes you feel like I wasted your time, I'll be the first to tell you. The people who did this 5 years ago, sleeping like babies. The ones who waited, running out of window. I can only take a handful of these a week. So if you're over 50 with more than 500,000 sitting in a 401k or IRA, don't sit on this. Click the link. Let's see where you stand. This is Frank Talk, and we're just getting started. Now that you understand why that money needs to come out of your 401k or IRA, the next question is, where does it go? Because if you just dump it back in the stock market, you solve the tax problem, but not the risk problem. In my next Frank Talk, I'm going to break open a strategy that gives you market-linked growth with zero downside risk. Market goes up, you participate. Market crashes, you lose nothing. Stay tuned for that one. And if you haven't seen Frank Talk number 2, where I cover what I call a tax-free retirement account, go watch that right after this. It could change everything you think about retirement income. I'll see you next time.